In this example video, we are going to review exercises 6.5 and review exercise 6.6. We're going to look at the difference of how we record our journal entries under the periodic inventory system and the perpetual inventory system. So in review exercise 6.5, we're focused on the periodic inventory system. And they tell us that our company has made sales on credit totaling $500,000 on April 18th. The cost of the goods sold is $400,000, and they tell us they estimate that 3% of their sales may be returned from this customer. And then they tell us on May 22nd, $9,000 worth of goods with a cost of $7,200 are in fact returned by that customer. So again, they're using the periodic inventory system and they want us to prepare the journal entries for our company. So on April 18th, we have an on-account sale. So we have accounts receivable in total of $500,000. That's technically how much we're owed from Alderman Sports. However, we know that there is a probability that we are going to get back approximately 3% of that sales. So whether that's the history specifically with this customer or with our customers in general, the company is basing that on something. So that means we can only record sales revenue at 97% of the sales price because there's a possibility that 3% of that is going to come back to us. So that means we only get to record $485,000 in sales revenue at this moment. We then have to put a return liability on our books for the other 3%. So that $15,000 goes on as a return liability. We do not have to do another entry here because this is the periodic inventory system, which means that we do not update cost of goods sold and our inventory levels at every point of sale. We only do that on a periodic basis when we go in and do a physical inventory count. So all we now need is an entry on May 22nd for when our customer actually returns something to us. So we're going to debit our return liability for that $9,000, and we're going to credit that customer's accounts receivable by the same value. So that is with our periodic method. We're now going to use that same information to look at how we would journalize the entries under the perpetual inventory system. And again, under perpetual, we're constantly updating our inventory and our cost of goods sold. So on the 18th of April, we still have that accounts receivable of $500,000. Again, we already know that there's a possibility we're going to get back 3% of our sales. So again, we can only record 97% of that value. And the difference goes on to that return liability. Of $15,000. This is the perpetual inventory system, which means that every time we make a sale, we have to have two entries, one to record the sales price, the other to record the cost of goods sold. So our cost of goods sold, they told us it was $400,000. However, we expect to get 3% of that back. So that means we're only going to record out of the $400,000 that we have in that cost, we're only going to record 97% of that, or in total $388,000. We also then estimate that we are going to have a return in terms of an asset. We think that we're going to get back about 3% of that inventory that we sold, or in total, $12,000. And then we have to reduce our inventory, what we're actually giving to our customer, by the total of that $400,000. Now, on May 22nd, when the customer comes in to actually return something to us, again, under the perpetual inventory system, we're going to need to have two journal entries. One to reduce the accounts receivable by the sales price, and the second to increase our inventory by what we're getting back from that customer. So we reduce our return liability by the $9,000, and we reduce that accounts receivable by 9,000 as well. We're going to be receiving less money from that customer in the future because they've returned something to us. And then we have to record what in fact they've returned. We now got back some of our inventory in the amount of 7,200. That was the cost value that they told us that we had. And I'm now going to reduce my return asset. So I estimated that I was going to get back around $12,000 in assets, and now I got back 7,200 of that.